The wealth strategy banks don't want you to know. Okay, so I'm going to tell you something today that is completely legal, completely available to you right now, and that the banking industry has spent decades making sure nobody explains clearly in plain English. Not because it's complicated. It's actually embarrassingly simple once someone lays it out properly. But simple strategies that make regular people wealthy are bad for business when your business model depends on regular people staying broke enough to need loans, paying interest forever, and keeping their money in accounts that pay almost nothing while the bank uses that same money to make themselves rich. I'm not being dramatic, I'm being accurate. And by the end of this video, you're going to see exactly how the system works, exactly how it's been working against you, and exactly what to do instead. I'm Naomi, this is my channel, and if you're new here, hi, you picked a very good day to show up. Let's get into it. Let's start at the beginning, because before I tell you what to do, I need to make sure you understand what's actually happening with your money right now. And I mean really understand it, not the vague sense that banks make money somehow. The specific mechanism, because once you see it clearly, you cannot unsee it. Here is what happens when you put $10,000 in a regular savings account at a big bank. The bank takes your $10,000. They lend it out to other customers at interest rates ranging from 7% on personal loans to 22% on credit cards to 30% or more on certain products. They collect that interest every month, reliably. Then they pay you. The national average interest rate on a regular savings account at a big bank is approximately 0.4% annually, sometimes lower, which means on your $10,000, the bank pays you about $40 per year. The bank is earning potentially $700 to $2,200 per year on your money. They're paying you $40. That is not a partnership. That is not the bank doing you a favor by holding your money safely. That is a transaction where the bank uses your money as raw material to generate significant returns and compensates you with an amount so small it barely qualifies as a rounding error. And most people know this in a vague, uncomfortable way and then do nothing about it. Because the alternative seems complicated, because investing feels risky, because the bank is familiar and familiarity feels safe even when it's quietly costing you thousands of dollars every year. Now let me explain compound interest. And I know you've heard of compound interest, but I want to explain it the way nobody explained it to you in school, which is in terms of what it actually means for your real life and real money. There are two kinds of compound interest operating in the world right now. One is working for you, one is working against you. And whichever one you feed more is the one that determines your financial future. It really is that simple and that binary. Compound interest working for you looks like this. You invest $5,000. It earns 10% in year one. Now you have $5,500. In year two, you earn 10% on $5,500, not just on the original $5,000. So you earn $550 instead of $500. Now you have $6,050. In year three, you earn 10% on $6,050, and so on. Every year, the number you're earning interest on gets bigger because the previous interest gets added to the pile and starts earning interest itself. This sounds modest in year one. It becomes extraordinary over time. $5,000 invested at 10% annually becomes $87,000 in 30 years. You put in $5,000. You end up with $87,000. The extra $82,000 came from compound interest working in your direction over time. You didn't do anything clever. You just left the money alone and let the math run. Now compound interest working against you looks like this. You carry a $5,000 credit card balance at 22% interest. In year one, you're charged $1,100 in interest. If you only make minimum payments, most of that payment goes toward the interest and barely touches the balance. The balance stays high. Next year, you're charged interest on roughly the same amount plus any new charges. The interest compounds, the debt grows. The minimum payment keeps the account open but barely reduces what you owe. This is why people carry credit card debt for years and feel like they're making no progress. Because they're not making progress. The 22% compound interest working against them is roughly equal to or greater than their payments. They're running on a treadmill that's moving backward. Same mechanism, completely opposite direction. The only question is which version you're participating in and how aggressively. Now, let me tell you what banks actually don't want you to understand, because it's not just the savings account math. It's the bigger picture of how the entire system is designed. Banks make money in two primary ways. They pay low interest on deposits and charge high interest on loans. The difference between what they pay you for your money and what they charge others for that same money is called the net interest margin. It is their core business, and for that business to work optimally, they need two things. They need depositors who keep money in low-interest accounts without asking too many questions. And they need borrowers who carry balances and pay interest indefinitely rather than paying off debt and escaping the interest cycle. The entire structure of consumer banking is engineered around these two needs. Low-interest savings accounts with convenient features that make people comfortable leaving money there. Credit products with high interest rates and minimum payment structures designed to extend repayment as long as possible. Rewards programs on credit cards that make carrying and using cards feel beneficial even when the interest costs dwarf any rewards earned. Dave Ramsey has been making this point loudly for 30 years. He says that the credit card rewards program is the bank's way of making you feel like you're winning a game that's rigged in their favor. The average household that carries a balance earns maybe $200 in cashback rewards and pays $1,500 in interest. The bank gave you $200 to take $1,500. They're not running a charity. They're running a brilliantly designed system. So here is the wealth strategy, the actual one, the one that works, the one that is genuinely simple and genuinely available to anyone, and that somehow still isn't common practice because the system is designed to steer you away from it. Step 1. Stop feeding compound interest that works against you. This means eliminating high-interest debt as the first financial priority. Not investing, not saving aggressively, not doing anything else first. Paying off high-interest debt, because paying off a 22% credit card balance is a guaranteed 22% return. No investment consistently delivers that. No savings account comes close. No strategy in existence reliably beats the guaranteed return of eliminating 22% debt. Pay off the highest interest rate balance first while making minimum payments on everything else. When that balance is gone, move to the next highest rate. This is what Dave Ramsey calls the debt avalanche, or what others call the mathematically optimal approach. You eliminate the most expensive debt first and work down. Every balance you eliminate frees up cash that can accelerate the next payoff. The momentum builds. The goal is to arrive at a place where you owe nothing at high interest rates, no credit card balances, no personal loans at double-digit rates, nothing feeding the compound interest machine that runs against you. Once you're there, everything changes. Step 2. Build a small emergency fund before anything else. 3 to 6 months of basic living expenses in a high-yield savings account. Not a regular bank savings account paying 0.4%. A high-yield savings account at an online bank which currently pays somewhere between 4% and 5% annually on deposits. This exists. It's FDIC insured. It's not complicated. It's just not the product your regular bank is going to walk you to the counter and explain enthusiastically because it competes with their low-interest products. The emergency fund is not an investment. It's not supposed to grow dramatically. Its job is to prevent you from going into high-interest debt when life happens. Because life happens. The car repair, the medical bill, the job loss. Without an emergency fund, these events put you on the credit card, which puts you back in the compound interest working against you situation. The emergency fund is the wall between you and that cycle. Step 3. Start feeding compound interest that works for you. This is the part that sounds complicated and isn't. You open a brokerage account or a retirement account. A Roth IRA, if you're eligible, is the best starting point for most people. You fund it monthly. You buy a broad market index fund, one that tracks the entire stock market, something like a total market index fund from Vanguard or Fidelity with extremely low fees, and then you leave it alone. That's it. That is the complete strategy, not stock picking, not timing the market, not watching financial news and making decisions based on what feels right. Just consistent monthly contributions to a low-cost index fund in a tax-advantaged account, left alone long enough for compound interest to do the thing compound interest does when you give it time. John Bogle, the founder of Vanguard, who invented the index fund, spent his entire career making one argument: that ordinary investors who simply buy the whole market through a low-cost index fund and never try to beat it will outperform the vast majority of professional investors over the long term. Not because they're smarter, because they're not paying high fees, not making emotional decisions, and not trying to outsmart a market that cannot be consistently outsmarted. The average actively managed fund charges about 1% in annual fees. An index fund charges around 0.03%. Over 30 years on a $100,000 investment, that fee difference alone costs you approximately $70,000. The bank and the fund manager are not your financial partners. They are businesses. Their interest and your interest are not the same interest. Let me show you what this actually looks like in real numbers, so this isn't just theory. Two people, same income, same starting point, different decisions. Person A puts $500 a month into a regular savings account, earning 0.4% annually for 30 years. After 30 years, they have approximately $186,000, almost entirely from their own contributions because the interest was so low it barely contributed. Person B puts $500 a month into a broad market index fund, earning the historical average of 10% annually for 30 years. After 30 years, they have approximately $1.1 million from the same $500 monthly contribution. The difference between person A and person B is $900,000, not from earning more, not from working harder, from understanding where to put the money. The bank was perfectly happy with person A. Person A provided deposit capital that the bank used to make loans, paid essentially nothing for the privilege, and never asked why their savings barely grew. Person B essentially opted out of that arrangement and participated in the market returns that compound interest in the right direction produces over time. This is the wealth strategy. It has been available the entire time. It is not secret in the sense that the information is hidden. It is secret in the sense that nobody who profits from you not knowing it is in a hurry to explain it clearly. Now let me address the thing I know some of you are thinking, because I've had this conversation enough times to know where the resistance comes. The market is risky. What if it crashes? Yes, the market goes down sometimes dramatically. In 2008, it dropped about 50%. In 2020, it dropped about 34% in about a month. These crashes feel catastrophic when you're in them. Here is what the data also shows. The market has recovered from every single crash in American history. Every one. The people who lost money in crashes were the ones who panicked, sold at the bottom, and locked in their losses. The people who stayed invested, or better yet, kept contributing during the crash and bought more shares at lower prices, recovered fully and then continued to grow. Warren Buffett, who has navigated more market cycles than anyone alive, has said repeatedly that the stock market is a device for transferring money from the impatient to the patient. The people who cannot tolerate short-term drops sell to the people who can. The patient investors buy those shares at a discount and hold them through the recovery. Time in the market beats timing the market. Every study on this topic reaches the same conclusion. The investors who try to jump in and out at the right moments consistently underperform the investors who simply stay invested through everything. The crashes are the price of admission for the long-term returns. You pay the price by tolerating the discomfort. You get paid back by the recovery and the decades of growth that follow. Here is the summary in the plainest language I can manage. Banks make money by paying you almost nothing for your deposits and charging others a lot for loans using your money as the raw material. The gap between those two numbers is their profit and your loss. Compound interest is the most powerful force in personal finance, and it runs in two directions. High interest debt uses it against you. Invested assets use it for you. The direction you feed more determines your financial future. The strategy that works is not complicated. Eliminate high interest debt first. Build a small emergency fund in a high-yield account. Invest consistently in low-cost index funds inside tax-advantaged accounts. Leave it alone for a long time. That's it. You don't need a financial advisor charging 1% of your assets annually to do this. You don't need a sophisticated investment strategy. You don't need to understand macroeconomics or watch the market daily. You need a Roth IRA, a total market index fund, automatic monthly contributions, and the patience to leave it alone while time does the work. The banks have great marketing, great apps, friendly branch staff, convenient locations, rewards programs designed to make you feel like you're getting a deal. The index fund has no marketing budget, no branch locations, no rewards program, just 30 years of evidence that it is one of the most reliable wealth-building tools available to ordinary people who understand what it does and have the patience to let it do it. You now understand what it does. The patience part is up to you. Subscribe for more of this every week. Share this with someone who needs to hear it in plain English, and I'll see you in the next one.